Hello, my name is Jeff Liautaud. It's September 11th, 2012, and I have a question for you. Have you noticed how the markets have been fluctuating so much in the year 2012? Rater traders can move the market up or down 3%, 4%, even 5%. Rater traders are people who are short-term investors who are hoping to make a profit in the near term. The reason for the market's volatility comes from rater traders, and also there is, though, a long-term trend that is trending upward. And the reason for that long-term trend is the fact that in this low interest rate environment, where CDs and bonds have an extremely low rate of return, it's actually an artificial rate of return. It forces investors who would otherwise invest in fixed return instruments like bonds or CDs. It forces them to invest in riskier asset classes, in particular stocks. And that's the reason why the long-term trend of the stocks are up, and the rater traders cannot halt that long-term trend. So then the question is, if you try to go in and go out in the choppy market like this, to what end? If the rater traders can take value out of the market as you enter or exit, then you're running a perilous path at this point in time. On the other hand, if you can stay invested, you don't run that risk. So invest in what? Look at symbol IYY. That's the Dow Jones U.S. Total Market Index Fund. And you'll see that over the last 180 days, it has been a consistent, it has had consistent momentum in an upward trend over that period of time, in the top 1% for momentum. My company, Treefort Financial, has a proprietary software program that measures that, and that's why I say it's in the top 1%. So by staying in IYY, you avoid this potential loss getting in and getting out. Another important investment is MLN. MLN is a symbol for the VanEck municipal bond, long-term municipal bond portfolio. This is one of the best investments in a low-rate environment like we have now. It is municipal bonds. It yields a 4% plus return after taxes, and its investment grade due date of the bonds is 30 years or more. So as a bond becomes no longer investment grade, it gets kicked out of that mix, and since there are 30-year maturity, there's low risk of default. Meanwhile, because the rate of return is reasonable, 4+%, there is a potential for some price appreciation, or more importantly, less risk of price deterioration. In other words, the price of the bond reflects the perception of where interest rates are going to go. At the present time, interest rates are very low, and they're low because the Fed is trying to stimulate job growth, and you do that through low interest rates. So money is cheap, and that capital can be put to work, and people can be put back to work. So I don't see that changing in the near term. That's why I say it's one of the safest investments. Now, an investor could add MLN to their portfolio of IYY stocks that represent the U.S. total market, and MLN is a basket of municipal bonds. By putting MLN in the portfolio, you reduce the volatility of the portfolio. you would do that based on risk tolerance. And for a consultation, give me a call, 773-594-9234. I'm Jeff Liautaud for Treefort Financial. Thank you. Be sure to look at the prospectuses for each of those securities. And if you contact me, I can make that available to you. Thank you.